they're cheaper on the other one, what are you going to be able to do? You're going to buy from the other one that's cheaper and immediately sell it on the one that's more expensive, right? And if you can do that, you've done nothing other than buy, sell. And in the process, you make money. That's literally the term they used is called arbitrage. And this happens quite a bit. When there's an inconsistent valuing of currencies, people that sit at their desk all day long looking to try to buy currencies, and they're buying the same currencies, they're just seeing where their varies are different, and being able to buy it and sell it. And it sounds like it's like, why would you bother doing this? Especially if the difference is, say, 3 pennies, right? What if you bought $1 billion worth of that currency? What's 3 pennies worth? Who runs the calculator? 3 billion, $1 billion times 3 pennies. It's a lot of money, you know, $30,000, I believe. And it's done like that. You hit a button, you hit a button. It's done. So again, I told you about Michael Lewis, this guy who wrote a book called Flash Boys. If you want to find out how high-speed trading and the arbitrage opportunity, read that book, listen to some stuff. It's incredible because they just move billions and billions of dollars in split seconds. They're making a penny or 2 or 3, and it's happening all day long. And that literally adds up to be billions of dollars. Okay, so what is the function of the market? Now we know where it is. It's a collection of banks. It operates across the globe. It's got a 24/7 opportunity where you can work with it. Their goal is to do currency conversion. And there's some key ones that we talked about. You have to buy and sell products. You have to convert your the currency you're generating in a foreign country into your domestic country. But there's also other things that you can use it for. So the book points out you got to pay for your exports, your imports, any foreign investments that you receive. If you got licensing deals, they're buying your license fee, you have to convert that. But there's also the opportunity to use that currency market separate from your production and your service. You could actually use it for investing. You could buy currency and hold them and sell them at a later date. You can invest in foreign countries' bonds, which are loans that the government is taking to finance their operations. There's another one called carry trade. Do anybody remember what carry trade was? It's a form of arbitrage, but Ben, you look like you're right on the edge.
I don't know.
Okay. So the concept, you're doing business in all these different areas. Some countries' interest rates are different than other countries' interest rates. The book uses the example. What if in Japan you could borrow $1 million for 1% interest? And what if you can invest money in the United States at 6% interest? So you go to Japan, you borrow $1 million at 1%, you convert that currency, the Japanese yen, into US dollars, and you'd invest it, and you'd be making 6% interest on that investment. So you're paying 1%, you're making 6%, that's 5% difference on $1 million. What's the number? Quick. It's been $50,000 for 1 year. That's pretty good. Okay, so there's more than just converting your currency to pay your bills. There's the use of that actual exchange to try to do some other financial investment opportunities. So how do you determine, how do you describe or discuss the exchange rate, right? So the book gave 3 examples. I'm going to only talk about 2. They talked about a spot and a forward. What is the spot rate?
You pick a certain day to exchange it.
Yeah, it's, hey, I want to buy some foreign currency. What's the price? I'm going to do it right now. That's the spot. It's the quoted price at the time of the transaction. Okay? Changes nonstop. If I said, hey, let's buy some this morning, oh wait, let's go buy some this afternoon, it could change between the morning and the afternoon. And what causes that change? Supply and demand on the daily market. So as people are buying and selling, if everybody's trying to buy a whole bunch of Japanese yen, they're going to start to become harder to get a hold of. The price will go up due to supply and demand. So what are the terminology used to describe this action, this transaction? So it's called the idea of trading currency pairs. Okay? Currency pairs are 2 parts. There's a left number and a right number. I'm sorry, a left currency and a right currency. It's called the base and the quote currencies. And all currency trades are made in these currency pairs. So the example that I have here, given the quote is a US dollar for a Canadian dollar and a 1.3, what is that formula? What is that quote telling us? Who can describe what's happening with that quote? I kind of broken it out in sentence
For
language,
one
but-
US dollar, you get 1.3 Canadian.
Exactly. So in this quote, and if you go to like Yahoo Finance or anything, just type USD/CAD, hit return, it gives you the currency rate. And it's because it's a currency pair. It's like a stock symbol, right? But it's saying, okay, how much of the second currency, how much Canadian will I get for 1 unit of the base? So in this case, $1 will get me 1.3 Canadian dollars. Let me see if I can pull that up and give you an actual example. Actually, I'm going to use something else. So this is just kind of an interesting example. So here, here's just an example of an exchange. You can log in, register, and actually conduct business here. We sign up now, we get a $30 gift card. But this is using the dollar as the base, and it's saying, what are we going to get? So $1 will buy how many euros? Not quite a whole one. 92% of a euro. And what's the trend going on right now as we're here doing this?
It's going down.
So the dollar is losing value to the euro, to the yen, to the Canadian dollar. It's interesting, when I logged in this morning before class, they were all red. So something's happened in the market. Something's happened in the market to change what's going on with people's beliefs about the future of the British pound. And I haven't read anything going on that I didn't hear about it. But anyhow, so this is just the concept of how to go about defining or describing the transaction and exchange. There we go. Okay. So again, we have a quote. It's made up of currency pairs. The first one is the base. The second one is the quote price. You're going to get, for the base, you're going to get the number of the quote. So the next part of this, that's a spot exchange. So for protecting yourself against future changes, they have what's called a forward. How does a forward work? What happens if you buy a forward exchange contract?
Don't you pay today's price for something like in the future?
So you don't get today's price, you get the price today for what somebody believes it'll be worth in 30, 60, 90 days, or whatever the contract is written. So it's kind of what you said. But I can tell you exactly how much I'm going to be able to buy yen for in 3 months. Because I'm going to buy it today, and somebody's going to go, let's see, the yen, if you looked on here, the book, the yen they were using an example is 120. The yen right now is like 142. So it's lost 20% of its value since the book was published. But yeah, the forward is a contract that you get a pre-agreement to say, I will sell you in a period of time, and as this points out, could be a month, could be 3 months, could be a half a year. But I will guarantee you, I will deliver you that currency at that price. And you have to decide, well, do I risk it and not bother to pay because it'll cost you, you might believe that might be worth more then, and you're going to actually be losing on the transaction. Or you might go, I think it's going to head south, I need to protect this dollar, so I'm going to buy that forward contract. What did the book say about the percentage of businesses that actually, this is called hedging, right? I'm going to owe you money in a period of time, or you're going to owe me money in a period of time, and I want to know what that number is in today's dollars, and I want to protect that. So I do something, I buy an insurance product, here it's called a forward currency exchange, to protect that. What did they say that of the large businesses, the large global companies that do international transactions, what percentage of them actually do any of this? How many do you think? Just if you were in this business, you're a big, massive company, you've got stuff going on all over the place, would you protect your currency exchange? No, not sure. Are you risk adverse? Do you figure nothing's going to happen? I go with it, not bother. I know you're young. You're college students. Tend to be a little bit more risk taking. I'd be afraid. I'd want to lock up my money, but apparently, small to medium firms, less than half of them actually do anything to protect their currency exchange. Some of the more larger ones, 60 to 70%. Only at the very highest level do like 70 or so percent actually do things to prevent this. And this can damage, if these things go south on you, they can really harm a company. So how do we know what a currency value should be? How do we know what an exchange rate should be? What should be the difference between two currencies? How do we determine that? Just conceptually, why would I get X number of these for one of these?
Can you repeat your question?
What's that?
Can you repeat your question?
How should the relationship between two currencies be established? We'll say it that way. I use the example up here, prices and exchange rates. What should they be? Right?
Their value.
Yeah, their value. Well, yeah, what should be? If I'm going to give you $1, how much are you going to give me? And what's that based on?
Supply and demand.
So supply and demand, but in this example, and we talked about it with the GDP, the concept of purchasing price parity. But here they use the term called the law of one price. And I used the example with currency exchange earlier, the concept of arbitrage. So if I can go into China and I can buy a Big Mac and it costs $10, and I can buy a Big Mac in the United States for $5, how much should China's currency be worth compared to the United States?
Double.
Or half?
Oh,
You're thinking the right way.
my bad.
Right. No. This is one thing. I have an exercise where your brains are going to get messed up because you're going, okay, is it this direction or that direction? There's actually a direction. But if I can buy a hamburger for $5 US and that same exact hamburger costs 10 in China, is China's currency worth half of ours or twice as much as ours? Half. So purchasing price parity was the idea of trying to get a sense of the value of money, so they create a basket of goods. So how much is a gallon of gas and a BTU of electricity, or a watt of electricity, a megawatt of electricity? How much is a carton of eggs? And whatever that is in these different markets, in theory, then the exchange rate should make them have the same value. Because if they don't, what's going on? I used the French term several times. What's that?
Laissez-faire.
Arbitrage.
Arbitrage, right. Because what I'll do is I'll go out and buy all this stuff and say, gosh, I can go there because my money is worth so much more. I can buy all this stuff and sell it over in my own market and make all kinds of money, doing really nothing other than arbitrage. So the argument in the law of one price is, if everything is consistent, and what we don't include in this, and this is a theory, and it doesn't perfectly work, but what happens is, if you take away tariffs and anything else, if it's free exchange, total perfect competition, no travel, no shipping costs, because clearly if I have to move it across, a great deal of distance, it's going to add some transportation fees. But if you take away transportation costs and any kind of tariffs, then these things should have the same value. So if they're priced differently in different currencies, the relationship should come out to be the same. Does that make sense? You following that? It doesn't work. It's theoretically the way it should work. It doesn't work. And so there's some economic theories that try to predict this, And they say, you know, there's basically three factors that relate to how prices will, how exchange rates move. One of them is just the actual price. And here we're saying the price should be, the price should be the same, so the exchange rate should be what adjusts the various currencies to the same price. But also that countries have interest rates, they also have market psychology that might cause some variation. So again, we go back to the purchasing power parity argument. It's the same thing. If a basket of goods cost X number of dollars, if our dollar, how did we use this with GDP or per capita income? This is like in our second or third class. How did we talk about the GDP of a country and how well people did or do their quality of life? So we said they might have a per capita income for a country of, let's say, Canada's is 20,000 and the US is 50,000. And you would go, oh, well, Americans, US citizens, they live better. They have more money. But if we went in and did that basket of goods and said, yeah, but that basket of goods in Canada costs half as much. So even though we have dollar value GDPs that are very different, when we calculate the economic value, you pointed that out earlier, economic value, when we calculate that, it looks like you can buy a lot more with the Canadians have more cheaper prices, so they can purchase more with their lower GDP. That's the concept of purchasing price parity.
Cost of living is different.
The cost of living is different, exactly. And for a basket of goods, ideally. So you would say that, you know, housing in general is cheaper in one location than the other. And in some places it's the other way, it's more expensive. And that's where I said, you know, they use this thing called the Big Mac. I didn't make up the Big Mac index, they actually use that as a method to vary, you know. And for the sake of full disclosure, I will pull up the Big Mac index. Let's just see what happens with the Google Big Mac index. Okay, so there it is. It's actually, it was created by The Economist, but if you go in there, they make you sign out. But other people use it. So this shows you, this is just a table of which countries are more expensive or less expensive in terms of the exchange rate. So here's just a list, right? So what they're saying is if a Big Mac based on a US dollar, in US dollars, in Switzerland it's 8, in the United States it's 5.69. So in a sense, the exchange rate, this should be 5.69. But because they charge that much more, it's overvalued. So, and again, if the theory worked, these numbers should be consistent, the exchange rate. But you don't have to study that. But it's an interesting thing to look at. Let's see, I'll pull this up one more time. So here's another way to look at it when we talk about the quote versus the base versus the quote. All of these are quoted in US dollar. They'll give you the opposite transaction too. If you just click the button, boom, now the dollar, how many it takes to buy a unit. Because it's which side of the equation is this on. So a British pound will cost $1.28 to get a British pound. If I flip it around, $1 will buy 0.77 British pounds. That makes sense how that works? That's why it's important to line up the transactions so you go, what am I starting with? What do I want? Because they work both directions. All right. So here we talked about, purchasing power parity. So what are the things that influence these changes so that they aren't perfectly aligned? What causes them to move? We talked about money supply and price inflation. What happens when you have, or let me ask you this, what's a definition, a real common definition, you hear it a lot lately, on what causes inflation?
Whenever they print too much currency and no one buys it.
So that's a cause, right. So when you print extra money, okay, anybody ever heard the phrase, too much money chasing too few of products. Because that talks about inflation from two perspectives. Too much money, you're printing money. All of a sudden there's lots of money. And when I have lots of money, I'll buy more stuff. And if I buy more stuff, but there isn't more stuff to buy, it becomes more expensive because you can get higher prices. Or if the cost of producing it goes up, then you're going to have to charge more for it. So prices go up. So it's really kind of a complicated, in terms of the money supply, is there a lot of money available to do stuff? And that can be done by interest rates. If you lower interest rates, people can go out and borrow more money, which happens. My house, my mortgage, my mortgage is 2.6%. In 100 years of mortgages, that's got to be towards the absolute lowest. And people went out and bought houses and bought houses and bought houses, and the price of houses went through the roof. Then all of a sudden, it's at 8 or 9%. So people would pay 4 times as much to buy my house in terms of interest. Whoa, that takes the money off the table and slows everything down. Now the prices are dropping. So again, if the money supply increases, then people find it easier to buy goods and services. They're going to be willing to pay more for them, and there'll be fewer available because people are buying more, and now there'll be this imbalance. So supply demand is a good driver. And they just generally see, any country with a high inflation rate will generally see the depreciation of their currency. Why would a high inflation rate lead to a decrease in value of their currency?
Because no one will be buying things.
Well, that might slow down production, but if it takes more money to buy that hamburger, then the currency doesn't translate to the other currencies where it takes less money to buy that hamburger. So all these variables can come into play, but if all of a sudden, for you to get something in the market, you have to hand a lot more of your currency over, people start to look at that and go, wow, that's not very good, that's not a very good position for that currency to be in. It takes more to buy something now than it did a year ago. So I'm not going to be willing to buy the currency. I'll pay a lower rate. I don't want to have that much of that currency. So then this is kind of the test from the chapter where they talk about, does this work? Do these purchasing power parity work? Do the law of one number, does that work? And they say really there's problems because you can't take away transportation costs or the different barriers to trade, like tariffs and things. So you're going to see different values in different countries. So you can't just take that basket of goods automatically and divide by the currency level. And a couple of different things. People in those countries can have more power in pricing. So it's not, it comes down to say the assumptions you need to make that model work are unlikely to exist. Governments are going to put up tariffs. You do have to move stuff around. It does cost. Some people can have a stronger position in the market and charge more. So it's not going to work perfectly. So, summary of these different things. What are possible reasons that currencies change and exchange value changes? Monetary growth, meaning there's more money available, so the supply demand. The relative inflation, how much more of a currency it takes to purchase the same item. Interest differentials, the government controls at the central level how much it costs to borrow money. That puts more money or takes money out of the market. And then the ultimate goal after the book, and I love the way the book sets this up. It tells you all these great theories to explain this, and at the end it says they're all poor. They're not really good. So what's the best way to kind of hedge your bets? Here, I think I have it on my next slide. Oops, yep. So this concept called the efficient market. Anybody ever heard of the efficient market hypothesis? So the concept of the efficient market hypothesis is the going rate, and this is usually used in terms of stock, but this is the same thing. This is like buying stock, buying currency, buying stock. It's what's the value, how's it going to change? The efficient market hypothesis says everybody knows everything about something, so whatever the official market price is, all of that is factored in. So it will give you a price that people have analyzed and looked at with all available information, and people will buy off the arbitrage until it settles at the price where everybody agrees that's the actual value. Okay? So what they're saying is, we don't know where this direction's gonna be, but whoever's willing to go out and issue a forward 30, 60, 90 days out and say, we anticipate the value of that currency in the future to be this, that's the best predictor that you're gonna find. Because the efficient market hypothesis says everybody knows everything, they're all analyzing what's going on. So if you wanna have a good sense of where the currency is going, look at what people are quoting as these different rates. How can you test that? How can you right now, as part of this class? It'd be a cool little project, but just go out and grab a couple of currencies and see what the 30-day markets are, or 30 or 50. And then in 30 or 50 days, go look at what the spot price is. And go, was this efficient market hypothesis accurate? Better yet, take $10,000 out of your savings account that you're going to use to pay for tuition next summer, put it in the market. Buy a bunch of currency. Okay, don't do that. And you can go to websites and they'll let you do that with fake money. Because when I was in my MBA program, we would go to a trading room, it's all fake money. But we would sit there and they would use live data, and you would sit there and you would do currency transactions and trades. And you know, if you made a couple $100,000 over the course of the semester, your professor rewarded you very generously. Okay, so how is convertibility? It's a whole other concept. So we have exchange rate. What is it? How is it calculated? What causes it to change? How about convertibility? How easy is it to move money in and out? I told you I have a bunch of German marks that are basically worth nothing. I mean, they're souvenirs. They're not tied to anything because I didn't dump them back into the market when I could have exchanged them for euros. So there's 3 different levels generally. Freely convertible, you can do whatever you want. Move the money in and out of any currency within the country. There's externally convertible. This means only people that are not local citizens can take money and convert it back out from the domestic currency. What's the issue with that? Why would you consider doing that as a government? What would be the benefit of allowing only people outside your country from having the ability to convert currency, but not allowing your own citizens?
You're not gonna lose like your money to other currencies.
You want to encourage people to come in and invest, and they're like going, if I can't take this back out in the currency I can use, I'm not interested. So you would say, yeah, we need to develop, but we're small, we're tight, we don't have a lot of funds, we can't allow everybody to do it, or we protect our currency. This is what happened. I told you in Egypt, when I lived there, the exchange rate was 3.14, and it's now like 50. The government controlled it, so it was always 3.14. Moved a little bit. I could have bought bonds for 11%, guaranteed government-backed bonds, but I had to convert my US dollar into Egyptian pound. I was stupid. I didn't trust it. I didn't realize it was completely locked by the government. I could have made guaranteed 10 to 12% on investments, but I had just moved there. I didn't really realize it. Because I worried what happened now would have happened in the time frame that I lived there. But then the next one is non-convertible. That's even more protected. Nobody can convert the money within. You're not going to allow people that do business in the country taking on their money that they've generated with their foreign direct investments, doing investment in business inside, not allowing them to convert it back out and take it back to their own home country. So that, again, you're trying to protect your currency, and it would be very unattractive unless you had a huge market and there was another way you could get around it. And here's some of the reasons why. They want to limit the currency to preserve their foreign market reserves. So they don't want people, a government's trying to gather up foreign currency so it can buy things for the country, you know, fuel, military supplies, stuff like that. They want to keep that available, so they don't want their citizens who believe, hey, our currency's going to, you know, turning into nothing. Let's quickly dump it and get some of these foreign money where it'll maintain its value. They try to prevent that. And that's what's called capital flight. People within a country say, you know, our exchange, or what was the example used in the book? The Bolivian peso, I believe, just went crazy. It became literally worthless because they kept adding zeros and just printing more money, and everybody's like, I don't even believe it's going to be worth anything. So everybody dumps whatever they have and converts it into a more stable currency. And then the last one is if it's non-convertible, you can still do barter. You can go in and say, you'll buy my product in this currency. With this currency, I will, instead of take the money, give me this commodity. And then you can take the commodity and sell it to some other country for their currency. And now you can convert that country's currency into your own. I mean, you got to be creative, but it is a possibility to still do trade and still get your money converted. It just has to be a little bit more complicated, or you're not actually using currency in the initial stages. So what are the risks? We talked a little bit about this, but we didn't talk about two of them. So the transaction exposure is a risk. And I establish a price, you owe me in your currency, here's the price in my head in the US dollars, and then that transaction, as the currency values change, that becomes, maybe I get more money than I expected or less, but it's a risk. I might not get what I want. So the next one is translation exposure. This occurs when you have to convert all of your assets in another country to a standard reporting format. Let's say you're a US company, you've got a business in Italy, and all of a sudden the Italian lira really declines in value, depreciates. You show on your books for your financial reports, which people base their willingness to buy stock in your company on the $10 billion investment you have in Italy. And all of a sudden, because of the currency devaluation, it's now cut down to half that. Does that affect you at all? It makes your company worth $5 billion less than you were, and the loss is all on paper. But it is a loss because you have to report that out. And people who look at your company go, oh my God, look at this, they lost $5 billion this year. Hopefully they're smarter than that, and they go, well, actually they didn't. They had the exchange rate issues. The company actually maybe did the same amount of business, same volume, but because of that translation, when they write it up in their reports, and they have to use a certain value at the time of the report, what's the exchange rate? So you can see that the transaction exposure is at the time you cut the deal or the time you pay for it. The translation at the time you report that. And then the last one is an economic exposure. And that's similar, but it's just takes more time. You've got a big investment in a country, and you put a lot of money there, it's going well, and the next thing you know, the military's dropping bombs on neighborhoods, and they're trying to have a coup, and oh man, and we've got all this money tied up in South Korea, and who knows what it's going to be like in 5 or 10 years. That's an economic exposure. Like there's just a long-term trend in inflation, or a long-term trend in government control reducing productivity. So how do you reduce economic exposure? What's the classic example? How do you offset risk associated with your investments, like in stocks and mutual funds or whatever? Oh, a mutual fund is an example of that.
Diversify.
Thank you. Don't have all your what in one what? Don't have your really expensive eggs in a imported basket. No. So yeah, just not be all in one country. Distribute it across a variety of countries. I think this is my last slide. Okay, one more. So how do we manage this? Oh, this is probably one of the big ones. Would you argue that this stuff is fairly complicated? There's a lot of moving parts. There's a lot going on. Businesses may lose sight of this. They might be looking at certain elements and not paying attention to like kind of basic things like, well, what's the value of the money? How does this convert when it comes back? Can we take it out of the country? And the book is pointing out, to really manage this, you need to have a really well-structured organization with people dedicated to following this. Know what's going on, know what each country's requirements are, keep an eye on what's going on with the trends of that company, so that you're really starting to look at a way that you can have dashboards. Where are we at? What's anything trending where we're going to start looking at, we need to buy some forwards, we need to start dumping stuff. And then ultimately, at least monthly update your reporting on it so that you keep a close eye on it. Because there's always horror stories that things were going great for some country, and then the currency devalued when they shifted it back. They lost 20%. They didn't make 10%, which would have been profit. They actually incurred a loss to produce something. That's it. See, foreign exchange can be fun. So I'm going to do this. I'm going to have you